The world is changing, and so does the expectation of investors, consumers, employees, and other stakeholders. The impact experienced by A. Climate change and B. COVID-19 pandemic has been a wake-up call and brought a change in perspective towards operating a business. Today, the best way to conduct a business is focusing on its sustainability by adopting environmental, social, and governance practices. These factors evaluate businesses and countries on how far and advanced they are with sustainability. Let's understand factors under ESG with examples. First, the environmental factor. This covers how organizations impact and are impacted by climate change and broader environmental issues, including biodiversity. Given renewed efforts to combat global warming, cutting emissions and decarbonizing has become more important. Second is the social factor. This factor looks at how the company treats people and concentrates on issues such as employee relations and diversity, working conditions including child labor and slavery, inclusion of local communities, health and safety, as well as conflict management. Third is the governance factor. It covers the means by which a company is controlled and directed, most usually through a board of directors. Governance factors examines how a corporation policy governs itself via board diversity and structure, corruption and bribery, compliance and review, executive remuneration, donation and political lobbying, as well as tax strategy. The importance of ESG reporting. There are four main reasons why ESG reporting is important and should be carried on by businesses. First, it increases corporate transparency. Second, it strengthens risk management. Third, it promotes stakeholder engagement. And fourth, it improves communications with stakeholders. The evolution of ESG in India, followed by a series of events. ESG reporting started in 2009 as initial steps towards the concept of business responsibility reporting. Ministry of Corporate Affairs (MCA) issued voluntary guidelines on corporate social responsibility, and Insurance Regulatory and Development Authority of India issued guidelines for corporate governance for insurers in India. In 2011, the Ministry of Corporate Affairs issued National Voluntary Guidelines on Social, Environmental, and Economic Responsibilities of Business. The reporting landscape changed since then and has come a long way with the introduction of Business Responsibility Reporting (BRR) in 2012, where SEBI mandated top 100 companies to file BRR based on National Voluntary Guidelines along with annual reports, which was then extended to the top 500 companies in 2015. In 2014, corporate social responsibility was mandated to be filed under CSR rules, and in 2017, integrated reporting was advised for top 500 companies which were required to prepare BRR. Then came the National Guidelines on Responsible Business Conduct (NGRBC) in 2019, which was mandated for the top 1,000 companies by market capitalization. The Business Responsibility and Sustainability Report (BRSR) has been introduced through a SEBI circular dated 10th May 2021. In May 2021, SEBI amended Regulation 34, subsection 2, subsection F of the LODR regulations to introduce the BRSR framework to replace the existing Business Responsibility Report (BRR), which is mandatory for the top 1,000 companies to disclose annually ESG-related information from financial year 2022-2023. Let's discuss BRSR framework. BRSR is more of an exhaustive disclosure framework than BRR. It provides a uniform framework for ESG disclosures, with a detail that makes it possible to compare with organizations working in the same sector. The reporting under BRSR is made a mandatory compliance from financial year 2022-2023. It is crucial for companies to prepare themselves for the change. BRSR is an effective compliance and communication tool for a company's non-financial disclosure and is the next step in mandatory ESG reporting in India. The Business Responsibility and Sustainability Report Framework is aligned with 9 principles of National Guidelines for Responsible Business Conduct (NGBRC), and the elements reflect the thrust of the United Nations Guiding Principles (UNGP) on business and human rights and sustainable development goals, and yet remain true and specific to the Indian context. The framework of the reporting questionnaire. Section A, General Disclosures. This section contains details of the listed entity, products or services, operations, employees, holding subsidiary and associate companies, including joint ventures, CSR, transparency and disclosure compliances. Section B, Management and Process Disclosures. It contains questions related to policy and management processes, governance, leadership and oversight. Section C, Principle-wise Performance Disclosure. Companies are required to report upon KPIs in alignment with the 9 principles of the NGRBC. Let's look at the ESG regulations globally. United Kingdom adopted UK Sustainability Disclosure Requirements (SDR) will set out disclosure requirements for corporates, asset managers and asset owners. The SDR will also include disclosure requirements relating to the forthcoming UK Green Taxonomy (UK Taxonomy). In 2021, the European Union adopted the Sustainability Finance Disclosure Directive (SFDR). The SFDR, together with a range of other EU sustainable finance initiatives. In Germany, on July 22, 2021, the Act on Corporate Due Diligence in Supply Chains, known as the Supply Chain Due Diligence Act, was published. The Act will enter into force on January 1, 2023. Its objective is to safeguard human rights and the environment in the global economy more effectively. It is very important for companies to establish a strong ESG program. Here are 3 steps on how you can do so. First, getting the basic rights. Second, strengthening the core. And finally, communicating the efforts. We have dealt with these 3 in greater detail in our ESG module available at ethicsindia.online. Some of the global reporting standards are Global Reporting Initiative's Sustainability Reporting Standards, GRI, CDP's Climate Change 2020 Questionnaire and Water Security 2020 Questionnaire, CDP, International Organization for Standardization's Guidance on Social Responsibility, ISO 26000:2010, Recommendations of the Financial Stability Board's Task Force on Climate-Related Financial Disclosures, TCFD, Climate Disclosure Standard Board's Framework for Reporting Environmental and Climate Change Information, CDSB Framework, Organization for Economic Cooperation and Development's G20 OECD's Principles of Corporate Governance, G20 OECD, United Nations Sustainable Development Goals, SDGs. Let's look at 2 case studies which establishes the need for ESG reporting by companies. The first is the Coca-Cola Amatil case, that's CCL. As we know, the majority of its products are non-alcoholic but high in sugar. BT Investments predicted social risks around high sugar and its link to diabetes and obesity is crucial. Further, regulatory risks including potential imposition of sugar taxes in key markets. Next, the AGL Energy. It is an Australian integrated energy company. The company operates retail and merchant energy businesses, power generation assets, and an upstream gas portfolio. IFM investors held steady investment rate in AGL Energy despite ESG concerns. climate change due to AGL's significant exposure to coal, as well as material financial impact on the environment related risks. Thank you, everyone. For further details, you may contact us on the email IDs or the contact numbers currently displayed on the screen.